Have I got a really great trading strategy for you to get your teeth into in this video? It involves Renko charts, one of my favourite all-time charts, and added with a bit of a Western approach of a few indicators that you might be familiar with. Together, very powerful. Like I say, it's got a great risk-return ratio of nearly 4-1 across most markets, and has a high win ratio over 70%. So, you know, a really seriously interesting strategy to learn. Now, mention it's on Renko. If you want to learn Renko and become an expert in Renko, I've got a free course, totally free, dives into everything you need to know about Renko, and it's here on YouTube, and I'll put a link in at the end of this video for you to follow if you want to find out more there, and in the description below this video as well. So I think it's about time we got on with diving into this strategy and see how you can put it into your trading. Right, so this really is a nice, straightforward, simple strategy, and I'm going to use the example of the Nifty 50. That is the Indian stock market. Here in front of you got the SGX, that's the Singapore Nifty 50 Index Futures contract. Now, why the Nifty? Because this was the first market I actually built this strategy on, and around a few years back, and since then I've taken it across all sort of markets, as I mentioned in the introduction. So I want to start back in the roots to show you how it works, and we're just going to go to start with through the inputs and what you see on the screen now. So component parts. At the bottom we have the stochastic indicator. Now if I click on the settings, you can see the inputs set to 12, 3 and 3, and then we have this grey shaded area which is actually Bollinger Bands. Again, if we go to the settings, you can see it's very short. I've adapted them 5, 1, 2, standard deviation of 1 and a slight offset of 2, which then gives us this way into the trade and out of it, as we'll see shortly. Then we've got this green and purple changing line. That's a simple moving average. Again, if we click on the settings, just set to 7. You don't have to use this MA ribbon, you can just use a standard moving average if you want. And then we have the blocks themselves, the Renko blocks, and you can see this time for the Nifty I've used a 35 sized block. And as you learn Renko, and if you don't know much about it, like I say, I recommend you have a look at my course. Getting the block size is pretty critical to getting this strategy right, and like I say, in that course I go in a big amount of detail how you can achieve that. But for this video I'm just going to concentrate, like I said, on this one market and the inputs there. Not going to go into too much about how I came up with them, but what I want to show you now then is how the actual strategy works, and it is really simple. You've got many options as well to enhance this strategy, get bigger in trade sizes, add trades, take them off, so you can do what you like with it. But I'm going to just show you the basics in play at the moment. Now, first up, the stochastics cross. Very simple. We're not that worried about the 80-20 zone. That's the overbought oversold zone. As you can see, as it crosses, we've got this change in the block from red to black, indicating a buy, and we would go into the trade there. And what you can do then is then trail it up behind this moving average or the Bollinger Bands, and you can be as aggressive as you want. You can take the top of the Bollinger Band or the moving average and get out as it crosses through on the close there, or you could follow it up maybe for the bottom part of the Bollinger Bands for, you know, a longer run up, stay in the trade longer. You might give a bit more back at the end, but as it crosses through you close out. And it's exactly the same to the reverse. So we look for the stochastic cross, you can see it there, and then we simply get in the trade, same rules to the opposite side. Now also, you know, if I see these overbought and oversold areas, I sometimes do like to wait for it to get back into, like I say, the 80 zone if you are using that as a rule. But my general rule is when they cross and I combine it with, you know, like I say, that change over there in the block size. Now, to enhance this further, I've added on this Bollinger Band set up with an offset. Now, How do I use that? Well, going back to our example there, we've crossed over and we've seen the blocks change from red to black, so that's bullish. And quite simply, you've got two choices here. You can be more aggressive and buy in as that first block there enters into the bottom part of the Bollinger Band, or you can wait until it breaks out through that second part, the top part, and then trade your way up there. So you can put that in combination, so you can have the stochastic part there and wait for the other variables to take place and then join in, or you can break it down to two strategies. Just have stochastics on its own and have the Bollinger Bands on its own, and the Bollinger Band part works exactly the same for the risk management. We trail it up and wait till it goes back in to the bands up there, or crosses that moving average line. And really, that is absolutely everything you need to know. It's as simple as that. And you're going to ask, well, what about the results? Well, I'm quite a quantitative statistical trader, so I've back tested this thoroughly. I've actually even automated this whole process and built my own through processing system, so it all executes very nicely for me. And 1 year I've made nearly 300% on this strategy just alone. So I just wanted to cover off some risk trade management issues, so they're firmly cemented in your thoughts. Now, going back to our initial trade example here, where do we put our first stop loss point? Well, I'm going to stick it in under that turning point there, and you're then going to go, well, what's the targets? Well, this doesn't have a fixed target because it gets taken out on those rules there. But what we do so we don't miss out on any of this great run up you can see here, is I would like, and often will trail my stop up behind this bottom part here at regular intervals. Now you can set them as part of your strategy process, so it's just locking in at consistent times the profits, and it's exactly the same to the downside. We've got in this area here, and it's a case initial stop loss at the turn, and then we trail it down there. If we want to be more aggressive, get in down into this upper Bollinger Band area there before it then comes in here. I'll leave that for you to decide, but I normally just stick with the following under that lower one and then let it do its stuff. So it's quite a nice strategy because like I said, it's a rule based one, and you're not like picking 1.5% move or break for a trend line that you've drawn on. It's using the indicators to get you out of this trade when the blocks turn against your trade. So that's a bit about the trade and risk management process. Let's just have a look at the backtest I did on the Nifty 50, just to give you an idea of the potential of the strategy, drawdowns, risk returns, those sort of variables that are key to understanding when you deploy this kind of trading play. So the back test I did was over 3 years, and if you see in the bottom left there the number of trades, you can see there's only 103 trades over that period. But if you start adding in other markets to trade as well, you can build up a serious portfolio here. And first, attention drawn to that black line, that's the P&L line. Just see how nicely that grows over those 3 years. The red shaded area is the drawdown. It spikes a little bit, but nothing significant. That's the numbers on the axes on the right hand side there. On the left hand side, that's how many points you would have made out of the index. Now, going through the stats down at the bottom, you can see quite a decent win rate there. Ranging between 62 and 75%, averaging out at 69%. You can see how many points you've won to how many points you've lost, and also the maximum loss points there as well, with some other interesting data around the drawdown, the win points, and the average loss and average win points, to give you an idea of how the risk reward plays out. And you can see on average it's just under 4 to 1 for this strategy. And how many losers you get in a row? Average is about 3 maximum, so that gives you comfort in when you put on the strategy you're doing the right thing. But really, takeaway is that nice trend line for the P&L, profit and loss, going upwards like a side of a mountain. Very nice, very attractive, and that's what you want to look for in a backtest. Now, another tool I like to use when I'm putting these backtests together to get an idea of how the P&L behaves and see whether my model idea works is something called value at risk, and you can see the up and the down sides with those thick red lines there, and what those dots are the daily P&Ls over the backtest. And what I'd expect to see, and I've used a 99% confidence level here, is that 3-4 times a year the numbers fall outside of those red bands. Now, if I see more than that, the model's probably not working. I've got to do some rejigs and retesting, but as you can see from here, most of the P&L falls nicely within those bands, so I'm confident that the model idea is going to work. So we've seen the backtest results. Like I said, the actual live results were just as good and very profitable for me. Like I said, take this away, learn it first before deploying it. It's not a get rich quick scheme. Do your due diligence, take your time. Like I say, do the tests, find out what markets it works on, learn about Renko, and at the end of the day you're going to have, you know, another good strategy to add into your arsenal and, you know, give you that trading edge that you might be looking for. So there you go, what I think is a fantastic strategy based around Renko. One of my favourite chart types, really enjoy trading those, and I think you should take a look into those some more. And one of the critical takeaways from this video is that the key, if you're going to move across markets to say forex, commodities, whatever it is, stocks, you know, you've got to do your homework, do your due diligence, and most importantly you've got to get that block size right. You know, that is critical to getting the right entry and exit signs, you know, getting the right amount of trades and creating a winning strategy. And if you want to learn about the Renko, then here is that course that I talked about earlier.